tax you pay every year without noticing. In 1971, you could buy a new car for $3,000. Today, that same car costs $30,000. You've been told this is normal, that prices just go up. That's how the economy works. But here's what they don't tell you. Your money didn't get weaker by accident. Someone made it weaker, on purpose, every single year. And you've been paying for it without ever getting a bill. This isn't about income tax. This isn't about sales tax or property tax or any of the things you know you're paying. This is about the tax that doesn't have a line item, the one that doesn't require your signature, the one that Congress doesn't vote on, but you pay anyway. It's called inflation. And before you roll your eyes and think this is another boring economics lecture, understand this. Inflation isn't just prices going up. It's a transfer of wealth from you to someone else every year in silence. By the end of this video, you'll know exactly who that someone else is. Let's start with something simple. You have a $100 bill in your wallet right now. Real money. You earned it. You can hold it. Now imagine you decide not to spend it. You're going to save it. Be responsible. Put it away for 10 years. In 2035, you take out that same $100 bill, same serial number, same piece of paper. But here's the problem. It's not worth $100 anymore. It's worth $73. You didn't lose the money. You didn't get robbed. You didn't make a bad investment. You literally did nothing, and $27 vanished. Where did it go? This is the magic trick of modern economics. And like all good magic tricks, it works because you're looking at the wrong thing. You're watching the prices go up, the grocery bill, the rent, the gas pump. You're blaming corporations or supply chains or greed. But prices aren't the trick. Prices are the misdirection. The real trick is happening to your money. Let's talk about where money comes from, because this is the part they don't teach you in school. You'd think money comes from the government, right? Like the Treasury prints it, and that's that. Wrong. Most money in the economy isn't printed, it's created out of thin air by banks. Here's how it works. You go to a bank and take out a $50,000 loan to buy a car. You'd assume the bank is lending you money it already has, money that other people deposited. Nope. The bank creates that $50,000 the moment you sign the loan agreement. They type it into their computer system. It didn't exist before. Now it does. This is called fractional reserve banking, and it's not a conspiracy theory. It's literally how the system is designed. Every time someone takes out a loan for a house, a car, a business, new money enters the economy, money that wasn't there yesterday. Now here's the problem. When you create more money without creating more stuff to buy, each dollar becomes worth less. Think of it like this. You're at an auction. There are 10 people bidding on one painting. Everyone has $100. The painting sells for $100. Now imagine I walk into that auction and hand everyone another $100. Free money. Now everyone has $200. What happens to the price of that painting? It doubles. Not because the painting changed, because the money changed. This is inflation. More money chasing the same amount of goods. Let's put some numbers on this. In 2020, the United States had about $15 trillion in circulation. By 2023, that number was $21 trillion. $6 trillion created in 3 years. That's 40% of all the money in existence. Now ask yourself, did the economy produce 40% more goods and services in those 3 years? Did we suddenly have 40% more cars, houses, food, and products to buy? No. We had the same stuff, we just had a lot more money bidding on it. So what happened to prices? They exploded.
Between 2020 and 2023, the average price of a home in the U.S. went from $300,000 to $420,000. Groceries went up 25%, gas doubled. Everyone blamed COVID, supply chains, Putin, corporations. But the truth is, if you create 40% more money, you're going to get roughly 40% more inflation. That's not economics, that's arithmetic. And here's where it gets personal. You didn't get 40% more income, did you? The median household income in the US went up about 7% during that same period. 7% income, 40% inflation. That gap? That's the invisible tax. You got poorer, not because you spent too much, not because you didn't work hard enough, but because someone created trillions of dollars and diluted the value of every dollar you already had. Now let's talk about who wins. Because here's the thing about inflation. It's not equal. It doesn't hurt everyone the same way. If you're holding cash, you lose. Your savings get weaker every year. If you're on a fixed income, like a retiree on Social Security or a pension, you lose. Your payments don't keep up. If you're young and trying to save for a house, you lose. The down payment keeps getting more expensive faster than you can save. But if you're in debt, you win, because inflation makes your debt cheaper. If you borrowed $50,000 5 years ago, that $50,000 is worth less today. You're paying it back with weaker money. And who has the most debt in the entire economy? The government. The U.S. federal debt is $36 trillion. That's trillion with a T. And every year, inflation runs at 3, 4, 5%. That debt becomes easier to pay off, not because they're paying it down, because the dollars they borrowed are worth less now. Inflation is a stealth bailout for borrowers, and the biggest borrower is the government. It's not just the government. The people who benefit most from inflation are the people closest to the money printer: banks, large corporations, investors who own assets. Here's why. When new money is created, it doesn't enter the economy evenly. It doesn't drop from helicopters into every neighborhood at the same time. It flows through banks first, through Wall Street, through large institutions. These are the people who get to spend the new money before prices go up. They buy assets, stocks, real estate, commodities, while they're still cheap. Then, by the time that money trickles down to you, prices have already adjusted. This is called the Cantillon effect, named after an 18th century economist who figured out that inflation benefits the people closest to the source of new money. You're not close to the source, so you get hit with higher prices before you see any of the new money. Now, here's the part that should make you angry. The Federal Reserve, the institution in charge of managing inflation, has a target: 2%. They say this like it's a good thing, like 2% inflation is healthy, normal, necessary for the economy to function. But let's do the math on what 2% actually means for you. If inflation runs at 2% per year, your money loses half its value in 35 years. Half. If you're 30 years old today and save money for retirement, every dollar you put away will be worth 50 cents by the time you're 65. And that's if they hit their target. If inflation runs hotter, 3, 4, 5%, your money loses half its value in 14 to 20 years. This isn't a rounding error. This is systematic erosion. And here's the kicker. They don't even measure it honestly. The government calculates inflation using something called the Consumer Price Index, or CPI. It's supposed to track how much prices go up for a typical household. But over the years, they've changed the formula multiple times. They exclude certain costs. They use something called hedonic adjustments, where they assume that if a product gets better, the price increase doesn't count. Example, if your phone costs twice as much as it did 5 years ago, but it has a better camera, the government says the price didn't really go up. You just got more value. Sounds reasonable, until you realize your rent doubled too. and they're not saying you got a better apartment. If we calculated inflation the same way we did in 1980, the rate today would be closer to 8 to 10%, not 3. The invisible tax is bigger than they're telling you. So what do? You can't opt out of using dollars. You can't refuse to participate in the economy. You still have to eat, pay rent, buy gas. But the wealthy figured out the game a long time ago. They don't hold cash. They hold assets, real estate, stocks, gold, Bitcoin, anything that isn't just paper money sitting in a bank account. Because assets inflate too. If the money supply goes up 40%, asset prices tend to follow. Your house gets more expensive, your stocks go up, your gold holds value. This is why wealth inequality has exploded over the last 50 years. It's not just about who makes more income, it's about who owns assets. If you own a house, you're somewhat protected. If you own stocks, you're protected. If you're sitting on cash in a savings account earning 0.5% interest while inflation runs at 4%, you're getting destroyed. But here's the cruel irony. The people who need protection from inflation the most, the people living paycheck to paycheck, the people without savings, the people who can't afford to invest, are the ones who get hit the hardest. They can't buy real estate, they can't buy stocks, they're just trying to survive. And every year, their dollars buy a little bit less. Meanwhile, the wealthy, the people who own assets, who have access to cheap credit, who are close to the money printer, they get richer. Not because they're smart.
The people in charge will tell you it's necessary, that a little inflation is good for the economy, that it encourages spending and investment. And maybe that's true, but you should at least know what it costs you. Because every year your money loses 2, 3, 4% of its value. Someone else is gaining. The people with assets, the people with debt, the people close to the printer. You're not close to the printer. So here's the question you need to ask yourself. If the system is designed to slowly take value from your savings and transfer it to people who already have wealth and power, is that a bug or a feature? Maybe you should think about that next time you check your bank balance and wonder why it doesn't go as far as it used to. The answer isn't that things got more expensive, it's that your money got cheaper, and someone made it that way.